Hey everybody, happy Thursday. Happy, well, in some cases it might still be morning. So I was going to say happy Thursday afternoon, but happy Thursday. Hopefully you're having a great day. It's been a good start wherever you are. Certainly appreciate you taking the time to join us for our next installment of our Flagstar Flex series. And before I introduce our guest speaker, who I'm excited about having on the program today, as always, a couple things real quick. Hopefully your loved ones, safe, healthy, doing good. Obviously, as we continue to go through the evolution of the pandemic, obviously we hope and pray that you all stay safe and are taking the necessary precautions to make sure you and your loved ones stay safe. So that's first and foremost. And again, thanks for joining. Obviously, it's our Flex series. We're trying to bring, I think, starting since February until now. It's crazy to think we're already in the fourth quarter of 2021 and starting to look at strategies for next year. But to take a step back, we started this in February, and I think we've provided some really good content, quick hitting material that hopefully has added value for you. And we look forward to continuing to do this as we move forward. So with that being said, hey, I'm really excited about our guest today. And we can bring him on stage if we want to. His name's Jason Lee. If you haven't had a chance to meet Jason in a past life, Jason's our Executive Vice President of Capital Markets over at Flagstar. I've been, I'll say he's been fortunate enough to know me now for, I think it's probably 15, 16 years off and on that we've worked together, minus like a year where we took a break from each other. So, Jason, welcome to the program. How you doing?
Good. Thanks, John. Looks like you need to get some stuff on your shelves back there.
Yeah, I'm working on it, man. There's a printer, there's a Cowboys helmet, and there's a book. I'm gonna start playing games on like these webexes, like who notices what I've added as I continue to fill it up.
There you go. Yeah, a little where's Waldo? Yeah.
That's right, buddy. But hey, man, really glad you could come here today. Obviously, I think there's a lot of uncertainty as we move into the fourth quarter, and a lot of conversation and concern around what does 2022 look like as we move forward. And I think a lot of people hear, things around tapering, what the Fed will or won't do with QE, recent changes in FHFA, the administration, and then you just start looking at like the normal course of business, right? Like what's it going to look like from an overall size of the market, the mix, and all that good stuff. So, let's kind of dive into it, man. I want to get some of your thoughts on that. I know you prepared some slides for us, so we'll pull those up as we're talking. But let's get into it. So what are some of the things you're looking at? And what are some of the things some of our business partners should be looking at?
Yeah, for sure. So I think we got to go one slide back, actually.
Yeah, I think we got to go one back.
Well, yeah, to your point, John, let's talk about, we don't have a crystal ball or, we can buy a magic 8-ball and guess at stuff, but we've got some indicators and some things that help us guide us to what we think will happen. But obviously, what we think will happen and what happens can differ, but we have a pretty good idea of where the trend is, and the trend's usually your friend, right? So
that's right.
So first off, I'd like to kind of just fill in and talk about what we see from the Federal Reserve. So lots of hoopla lately about insider trading and everything else, but these guys really control the future of the short-term rates and the interbank lending. And so what we put together here to show folks on the call here is what were they thinking back in June versus what were they thinking in September. And so the dot plot, I actually had to look it up before this call. It came out in 2012 is when they first started to show what the thoughts of the individuals and what they were thinking for rates going forward. So we're almost at 10 years of this, which feels like it was yesterday, but that was really a big move in transparency and showing us what they're thinking. But if you look back, it's not too much terribly different, other than in 23, back in 2021 of June, in 23 they were looking at 100 basis point 10-year, and as of last month, now they're somewhere around that 125-ish is where the trend is higher, moving a little higher. And then you got three folks there that are over 150. But I think the longer term scope, now that we're getting a better picture, is where are we going into the next couple of years now. out to 2024, we're looking more at over, somewhere in the 200 to 250 basis points in a 10-year. And then longer term, it looks like they're kind of stabilizing out there, which it's a little too far to predict, but that's where they're at today. What does this affect? This really affects the credit cards, short-term car loans, anything with that less than 5-year kind of tenure. That's really what we're looking at here, and that starts to move the curve. The curve starts to fluctuate all the way up, right? So on the right there, I think this is kind of a cool little box that the team put together. It shows you kind of the change in thought pattern of what these members of the FOMC are thinking year over year. And so you can see in that 2023 prediction or insight there, that plus 100 move, there was 3 people that moved over to that column there. So definitely a little bit of change of attitude and demeanor where we're heading into the next couple of years here.
Yeah, I mean, if you look at that box at the bottom right, Jason, you're probably looking at what, 2, 5, 6 members in a very short time period from June to September. Again, in instance, really 4 of the 6 significantly raising their target upwards of 100 to 150 basis points from where we sit today.
That's right. Yeah. So I think that really is a good snapshot and a kind of like the cliff notes of what's kind of happened year over year, and where, once again, like that trend and the momentum of where we're heading, that tells you that, these guys feel rates are going to go higher. And I think most people feel that way as well. But that's really where we're at today, and we'll see what the next FOMC meeting and what the next dot plots come out at. But that was the most recent where they're at. So
yeah, and before we get into the next thing too, I forgot to mention this. I usually do it at the beginning. If you have any questions along the way as you're viewing this, right, you can enter your questions in below. They'll come through to me, and we'll either address them towards the end, or we can address them as we're going through some of the slides. So sorry, Jason, just wanted to throw that out there. I forgot to mention that.
Yeah, no problem. So the next slide here we'd like to take a look at is the lever that they pulled in March of last year when the pandemic really hit and the economy went into a free fall. And who's going to invest in mortgage-backed securities and treasuries? And the Fed came in, not too dissimilar to what happened in 07, 08 for us that lived through that one. So lots of sleepless nights and flashbacks during that period too. But you can see what's happening now. They've indicated, early indications months ago where, well, we're going to wait till mid next year. Now they're talking November, right? So they think things have recovered to a point where they can start to pull back on purchases. And what that means is, if you follow this coming from March, April, that number 1 there marker on the graph, that's when they really started to come in and hit it hard and start buying mortgage-backed securities to support. And that's when we rallied, right? And that's when the rates dropped. You've got basically the best credit in the world buying the mortgage-backed securities, and it just went nuts. And we rallied. I don't remember anymore, 200 or 300 basis points in price, and the epic refi boom began, right? So
that's right.
They did that for a couple months. Finally, kind of came to their senses, like, you guys don't need to buy everything. Like, there still are people out there that want to invest in mortgage-backed securities, and we need to right size this ship a little bit and not go crazy. So they pulled back dramatically there in May. You see that graph drop quite a bit, and then they've been they stabilized it here through the last, call it month, year and a half or so. But we're heading in towards that number 4 spot on the graph there when tapering will commence. And so, what does that mean? It's hard to tell yet, but there are a lot of deep liquidity and a lot of buyers out there that want to own U.S. mortgage debt, and especially since it's explicitly guaranteed by the U.S. government when it comes to Fannie, Freddie, and Ginnie Mae. So there will be probably, we'll see a little bit of some blips here as they start to taper off, but the backfill will come in and the dust will settle, and there will be buyers out there. Pension funds, foreign countries, insurance companies, you name it. There's a lot of folks out there trying to grab yield. And if you can buy some mortgage-backed securities guaranteed by the U.S. government at 3, think about that. 10 years at 150, 160, you're going to get the same guarantee at 3. There's going to be, there'll be buyers. So I wouldn't put too much stress on that. I wouldn't worry about it too much. I mean, we will probably settle out. Rates will go higher. We'll settle in a little bit, but it's not going to be a cataclysmic event, I guess, is what I'm trying to say.
Yeah, and I think that's everybody's natural reaction, right? Because if you really look at this chart, I mean, let's face it, we're still living through, you called it a refi boom, right? The pandemic hits, and then, I hate to say it this way, but it does seem to be like, if you go back over a certain period of time, right? You had Brexit, you had the tariff wars, you had now unfortunately the pandemic hits, right? And you see those different spikes in volume based off of how, the mortgage market reacts, right? From a rate perspective. And I think that's the fear that everybody has, to your point, right? Which is, you see these charts, right? January and February prior to March and April of 20 were not non-existent, but nowhere near the levels they were to help sustain us through the pandemic all the way up until, starting, really technically, as you look at this chart, probably November into December and ending completely in June, getting back to what would be a normal state. And I think people tend to look at that as a disruption, when in fact, based off of kind of what you were just saying a second ago, it's just shifting the geography of where the mortgage-backed securities are going to be purchased, right?
That's right. And you could argue, most of that has been built in, right? I mean, we've seen the 10-year go from whatever 60, bottomed out at 60 back to 150. We've seen mortgage rates go back up to the low 3s from, where they bottomed out there in the mid 2s, low 2s at one point. I think we even saw some lender out there with a 30-year at 199. So yeah, I think for the most part, we're expecting it. It's built in. There might be a little bit of a hiccup here or there, but I wouldn't expect a sudden jolt or wake up in the morning and turn your computer on, you see an update that there's a 100 bip move in the market. I just don't expect that.
That's right. And I think that's one of the things in today's conversation I want to try to get through to our business partners is, this was inevitable, right? The street's been building this in forever. This was not something that was going to be this gigantic runway that the Fed continued to buy at this level for an extended period of time. And we're coming to the, in essence, in theory, the way we sit here today, we're just coming to the end of that runway, but it's already been built in.
Yeah. And I think, I mean, as taxpayers, as a citizen of the United States, I'd rather have them get out of the way and let the free markets back in, and let's get this thing going again. It's time to do it. So I think they're on the right path, and I'm actually personally, I'm happy that we're getting it done earlier than later. So I think it's a good thing.
Well, and that's certainly a couple things around the Fed, right? And that's what's kind of in the marketplace today. But I was just going to kind of segue into this. Let's take a look at what you're kind of seeing from expectations of the overall mortgage market next year and beyond, really, as far as estimates are concerned.
Yeah, and so I think if you throw out the outliers of the many years we've had these little refi boomlets or booms, the market, and obviously home prices are a lot higher than they have been 10 years ago, right? But 2 trillion, is that a right number? 2.2, 2.5? Where are we going to settle in? And that's kind of what everybody's really trying to figure out. So this year, I think, we've got on here just over a little over 4 trillion. Some folks are calling for 3.7, 3.8. But in the grand scheme of things, in the history of our business, I mean, it's still just an absolute, huge monster year. Nothing compared to 2020, and who knows if we'll ever see that in our lifetime again. But incredible $4.1 trillion. That's just an enormous number. If you think about just, they're trying to pass a $3.5 trillion deal in the government right now. And
that's right.
$4.1 trillion of mortgages. It's hard to wrap your head around that. But yeah, I think we're heading into a more normalized, rising rate environment, which means refi. We'll talk about that later, but refis are drying up. There'll always be refis, but the folks that are in the money or would make sense to refi are quickly disappearing. I mean, there will be some people that have to have a refi for whatever reason, life event type situation, but we're heading back into a purchase market. And, once the home builders come back online, materials, we get through this, what's that S word? Supply chain. Yeah. That thing. Once that thing gets figured out, the country gets back in motion and we start building houses again, and it's kind of the normal way of life, people moving up and down and first time home buyer formation, that kind of thing. But yeah, we're looking at, the refis dropping drastically in 2022. So forecasting 2.2 trillion, almost 2.3 trillion this year. And if you look at that drop to just under 1.2 trillion, it's half of it just evaporated. So the kind of the silver lining there is the purchase market, right? So you're going from a $1.7 billion purchase to 1.8, maybe higher, depending on what happens here with the economy, with the supply chain and builders and everything else going on. But it's still a very, very robust purchase market compared historically to even 2 years ago. Looking at just under 1.3 trillion in 19, and going back to 17 at 1.2. So, almost a 50% increase in purchase business in 3 years, year over year. So I think that's the focus. I think everybody's, that's kind of what we're going into the conference next week in San Diego, gearing up for. What are we going to do? How are we going to be able to manage, helping these borrowers, a lot of the first time home buyers, depending on what you read. I think there's a lot of stats get thrown out there, right? But the one that was kind of shocking to me, and I don't know, I can't remember where I read it, but it was over the next 5 years, there's 5 million people turning 30 years old. And that's your prime household formation, getting married, wanting to have kids, that kind of thing, buying a house, right? Depending on if they bought Bitcoin or they're still living in mom's basement playing Xbox at this point, maybe it's 32. I don't know. But there's a lot of people turning, in that 30 to 32, 28 to 32 range that will become first-time homebuyers, will want to move out of their parents' house, want to form families, and so on and so on, right? So,
yeah, I think there's a couple of things around that, right? On one of our previous Flex, we had Dave Stevens on, and he showed a graph of I think it was 30 to 35, and just the number was close to 8 to 9 million of that generation moving into that segment over the next couple of years, which will fuel that purchase market, right? Look, I think there's some call outs on this slide, right? I mean, we've been doing this for a very long time. I think that benchmark's 2 trillion, right? Like prior to 20, if you could say and forecast that you were going to have a 2 trillion-ish plus or minus, mortgage market, I think any economist would tell you that's a pretty healthy mortgage market, right? And if you look at 19, 20, 21, 22, and 23, even with the estimates of the drop in refi, you're still significantly above the 2 trillion mark. So there's plenty of opportunity out there. To your point, a life event's always going to structure or give us the structure to be able to do refis. And I think one of your guys shared on one of our internal calls the other day, just the sheer number of pent up equity that's been built up either between appreciation in homes, paying mortgages down, and or just liquidity from a personal standpoint that hasn't been used over the last 18 months. There's still plenty of opportunity for things like cash out refis and stuff like that. So it's not that refis are going away, but man, all indicators point to, for any originator that's listening to this, if you're not already focusing on what your purchase strategy is going to be for 2022 and beyond, you're already behind the 8 ball. Because by the time you start implementing and start going after that referral network, everybody else is doing the same thing, right? You need to lay that groundwork today. And I think this slide shows that really well, because the strength of the purchase market is going to be there for all the factors that we've talked about, plus more.
Yeah, no, I totally agree. I mean, it's, you get up to that 2023 estimate at 600 billion of refi. You're basically saying 3/4 of the refis this year are going away, right?
Yeah.
So I think, there may be, to your point about the cash outs and stuff too, I think there might be a little bit of a delay there just because of COVID, and the household savings is the highest it's ever been in the history of the country. So I think there is maybe, folks do have a buffer. They've saved a lot. They haven't been going out to eat or movies or, all that excess cash that they would have spent. It's been saved, but there will eventually be a need for whatever, right? A addition or college tuition or
That's
something.
right.
Something. Once again, another life event will come along, and it'll make more sense to do a cash out than to tap into a savings account or money.
That's right. Hey, look, unfortunately, divorce still happens, right? Unfortunately, at a pretty high percentage, and that's a life event where it pretty much mandates either you sell or there's a refinance transaction that's taking place, right, at some point.
Right.
But hey, as this next slide pulls up, it kind of goes a little bit more into the forecasting of it. So why don't we kind of talk through this a little bit?
Yeah, so this really gives you this is the MBA, and we look at we kind of take everybody and then kind of blend it and come up with our own. But we look at Fannie, Freddie, the MBA. But the MBA publishes this and encourage folks, if you go out to their site, I think you can actually sign up for free and get this stuff or download it. I'm pretty sure it's accessible. But you can see that in that red box there, the purchase numbers really just kind of being fairly steady there going into 2022, right? So you're actually climbing out of Q1, which it's more so seasonality probably in their estimates. Once again, just labor supply shortages, getting stuff done. And then by Q2, the hope is that we'd be out of that situation. And then going forward, it kind of starts to level off, maybe rise a little bit seasonally. But that's really what that story is telling you. And then just the sheer drop off the cliff there. If you look at Q1 of 2021 versus Q1 of 2022 and refis, I mean, you're going 774 to 176. That just tells you the story right there. It's just the refis, once again, get ready for purchase. That's where it's going to be at.
That's right. And I think your next slide kind of goes through that as well and shows some trends. Because let's face it, I mean, unless you're burying your head in the sand, rates are going up, right? Like we've had this run for a very long time. And by the way, even if you look at it today, right, 3.25-ish, kind of where we're settling. I know some improvements this morning, but if you just say 3.2, right, from a mortgage perspective, historically, if you go back 40, 50 years, I mean, you're still well below the 6.5 to 6.25 to 7%, which is typical for a 30-year fix, on a conforming loan amount. Rates are still really good, right? So from a purchase perspective, there's still a lot of buying power there, considering that rates are still so low.
Yeah, for sure. There was a tongue-in-cheek write-up that B of A did a couple weeks ago that, I mean, kind of half true, maybe it's true, I don't know, but rates are the lowest they've ever been in 5,000 years. It was pretty cool. It was kind of a neat write-up. But yeah, I mean, to your point, it's still, I mean, historically we're in a great spot, right? If you look at that red line there, we're heading, after we bottomed out there in 2020, we think we're heading into the 3 range on the 10-year. And once again, that we're showing you the purchase market here in the kind of the red bars, and then refi in the blue, with more of a estimate on the lighter blue there. But that's that tells you the story of kind of when the refis come and go there. The correlation, you can't deny it, right? Obviously, but historically, I mean, that's where we're at. I mean, going all the way back to 2009 at 3.25 on the 10-year. You were at a $2 trillion market back then. Obviously today, home prices are substantially higher. So, does that mean, kind of going back to the previous comments, does that mean a $2.5 trillion market is where we're going to settle? 3 trillion? We're kind of trying to figure that out right now, but that's where we're heading.
So the interesting part around that, Jason, I think is and I think this might be your next slide too, is when you talk about, really the impact to, I mean, there are owners that look at this, right, from our business partners' perspective. There are individual LOs. Obviously, in this industry, I've always said if you're an LO, you're basically self-employed anyway, right? You hang your hat somewhere and you work for somebody, but it's your own book of business. You contain it. And I think on the next slide, you kind of go into a little bit of that conversation around, what does this look like for overall volumes, shifting more towards a purchase mix. And then what happens to like margin from that perspective, right? Because a lot of people haven't lived through this cycle, right? For a good thing, for a lot of people in this industry, they've been originating in times since 18 to now where rates have been historically low. And now this is going to be the first time in their life cycle of originating loans that they're going to be doing it in a rising rate environment.
Right. Yeah. No, good point. So one of the key indicators that we look at, we're watching as Flagstar and like all of our competitors, our peers, right? It's like Walmart and Amazon and Best Buy. We're all kind of seeing and watching where everybody's pricing and what they're doing. But one good indicator that kind of the numbers don't lie is the 10-year versus where's the 30-year mortgage at. So we like to call it, or sorry, not 10-year, the pass-through spread to Fannie or Freddie, which is very similar to a 10-year. So what is Fannie or Freddie buying it at for a yield requirement, and what is the consumer paying on the back end? So this is really a 30-year based off the bank rate that they post, bankrate.com, versus the pass-through to Fannie or Freddie. And that gives me or us an idea of the compression on the margins or compression on profitability. So if you look back to 2020, you see that red line spike heavily. And that is right when we went into lockdown. The Fed came in to buy mortgage-backed securities, and we rallied, whatever it was, 200-300 basis points in the market. Obviously, just like, I'm from Detroit, so I kind of use car analogies, but there's only so many cars you can build a day, right? It doesn't matter if you got materials. It doesn't matter if you got a million people. The assembly line can only move as fast as its slowest link. You can only get so much output. So you've got a giant funnel at the top, and you've got this little output at the bottom. So as an industry, for the lack of a better word, I hate to use the word collusion, but we all try to tap the brakes, right? So we say, hey, we got to slow this down. We've got to meet the deadlines with the borrowers on purchase agreements. We've got to be conscious of being able to get the raw materials in the front door and then get them out the back door as packaged up in consumers. Because one thing that we forget, or sometimes we forget, or we lose sight of, is that we talk about loans and units and market size, but these are people. These are human beings. These are families. These are pets. People's lives, right? So we got to make sure that we can meet and satisfy the service levels that we expect as consumers too, right? And for our lender partners as well. So that's why you see that red line spike up. Is we say, as an industry, we have to slow this down. We can't go out with a 1.5 30-year fix because it would just implode. We would all blow up. So that's why you see that spike up, and then it starts to come down into mid-year this year, and that's really as there's kind of two things that happen, right? I think we have the most capacity in this industry we've ever had. I think there's lenders have been hiring like crazy, some more than others, but they've built massive production plants, if you will, right? So we saw that come back online. They can compete more. They can start lowering prices. It forces us all to kind of compete again. And you see that kind of keep coming down. And we'll get to a point where we level off and we all kind of, we all have our own capacity models and everything else, but we'll level off in somewhere, historically back into that range of 70, 80 basis points is where it kind of historically is. But you can see we're still off, almost a full standard deviation historically where we're at. We're still running high. So, the volume versus capacity, there's still a little bit of capacity, lack of capacity in the industry, even though we've built it to the biggest it's ever been. But once again, if you think back to that prior slide there, we're showing it's almost going to be a $4 trillion market again, right? So
that's right.
But expect that to come down more. So profitability will get squeezed. It's gonna become more of an efficiency, thinner margin business here in the next couple of years.
Well, and I think that's good for everybody to understand, not only from their investors' viewpoint, right, but from their own, right? So I mean that is not something that is just relegated or allocated to one side of the house, right? The overall profit margins are going to shrink in general just because of some of the factors we're talking about today, right? So I think those are things that you need to kind of take into consideration. And look, these primary secondary spreads that we're talking about, I know it's something we track religiously, right? So we can kind of see when they're widening or when they're narrowing, and it kind of gives you a foresight into the market that you're going into. And right now, we're certainly seeing that continue to tighten based on several of those factors. I do think your next slide sums up a couple really good points for the audience, right? Around some things that are consistent even as we move into what 2022 is forecasting to be.
Yeah. So kind of just back to a little bit of just overall market and profitability, what's going on here. So that top left graph, um, we're looking at GDP and disposable income, and you can see that we're sitting at disposable income higher than it's been in a long time, and that's why I think maybe cash outs might be a little delayed. We've got a lot of households sitting on a pretty decent amount of cash in their savings account too.
Well, and before you go on, think about this, right? That supply chain that we joked around about earlier, that plays a part in this too, right? If go call a contractor right now to come out and like build a deck or do something in your house. They'll write a contract, they'll take your deposit, but they're going to tell you it's probably 6 to 8 months before they start working on it.
Yeah.
And or you get into it. I'm dealing with this right now on one of my own. You get into it, and 3/4 of the way into it, the supply chain is now impacting the completion of the project, right? So to your point, I think some of that pent-up equity may have been spent already if we didn't have supply chain issues. Hey, these things loosen up, and now you're going to see that come right back into the market, I think.
Yeah, no, I agree. And I mean, personally, I have the same situation. I bought a house 2 months ago. My fridge broke.
That's right.
October 20 is my new date to get a fridge. So, yeah, I mean, it's just you don't think about those things because we're just so used to everything's available and just in time and around. But yeah, I mean, even the simplest things of trying to get somebody to come out to look at the smallest thing in your house, you got to wait 4 weeks, 6 weeks.
That's right.
It's just even good for them. But they're also trying, they're also having labor shortage too. They can't hire people. So
that's right.
Yeah. So that the box next to that on the right there goes back to what we talked about for age distribution. And I'm not sure what Dave showed in his prior Flex meeting, but that kind of shows you there. If you look at that younger generation coming in, pretty substantial, right? I mean, 22 to 40, you got 37% of the population in that space. And I wouldn't, I wouldn't ignore the next two bars there too, the Gen Xers and those early boomers. Some folks, especially, and personally, I know some that, 55, 57 live through this and they're like, you know what, I'm done. Like I've been going to the office for 30 years, working 8 to 6 every day. And I'm done. So I'm ready to downsize. I'm going to sell it off and go somewhere south or smaller or back north or wherever. But I think you're seeing some of that pandemic related, just people realizing how fatigued they really were and they're just done. They're out. So I think you've got, it's kind of the way the graph is kind of laid out there too. It's funny. I mean, you got people coming up and in. So people moving in, first time home buyers, moving into bigger houses, and then downsizing, right? Downsize, second home, that kind of thing. So a lot of interesting information around demographics and age and just that whole household formation and deformation. Existing homes and new sales. I mean, I think this is kind of speaks for itself, right? We know that existing homes are in short supply, and I think it's hard to put a number on it right now or completely understand what's happening, but there's just a lot of new dynamics, right? You've got Blackstone or BlackRock. I always get those two confused. Buying up entire neighborhoods from builders. You've got investors buying more houses than they ever have in the past. So the amount of houses, especially in that lower bracket, lower range for first-time home buyers is very limited. So, that more to come on that as home builders are able to fill that gap. But there's definitely some newer ideas or entrants into the market that weren't there before that are putting a little bit of strain on the supply. And then as far as housing prices, I think we've all witnessed that, right? We've seen the prices just kind of astronomically pop up, especially in certain geographies around the country, in the Sun Belt. as the migration started, probably Q2 of this year, when people realized they don't have to go back to the office, we really started to see some movement there. And then going back to the savings, people saved up money. I mean, they were able to put a down payment down and get a house. And
That's right.
the houses weren't there, or you had to bid against 20 people to get a house. So it's been an interesting a year and a half here, seeing what happens, and more to come on just the ramifications of everything with the shutdown and the pandemic and how that's going to affect us. It could be. I mean, obviously, I think it'll be another 5 to 10 years we really understand the true effects of all of this.
Well, so then I think there's a couple of questions. I'll save them till the end. But I think you have a slide coming up on delinquencies, right? And the trend around that. I know that's obviously something that everybody, it weighs on people with regards to that, but kind of thoughts around delinquency.
Yeah, I wanted to include this just because there was a lot of, at the beginning of the pandemic, especially when the CARES Act got thrown out there, and folks took the option to not make payments anymore. I think that a lot of that was strategic. And there was a lot of folks recently, before the foreclosure moratorium stopped and everything else, that, the sky's falling and people are going to lose their homes, and we're going to go back into this 2008 thing. And it's just that's not the case. Right. I think that the numbers are here. You see, we're heading towards, you see the spike, which is pandemic related. And now you're seeing it come back to normal. And what we saw in our own portfolio was people took the option, but some of them still made the payments. So, I think they took it as insurance. Like, hey, you know what? I might lose my job, or, things are getting a little sketchy, or we lost one income. We might be able to make the payment, but I want to have that optionality if I do lose my job, or my husband or my wife, my partner already lost their job, to have that backup to know that we're going to be okay. And we saw that. We saw it in our own book. And so I think it was way overblown what was going to happen. I think Dave Stevens, earlier today, they quoted him on CNBC, and he was talking about 2008 versus this time. And, the quote, the old quote, "This time is different," which is hilarious, but it comes up every 7 years, it seems like. 2008 home prices dropped 20-30%. 2021 home prices jumped 20-30%. So
That's right.
It is different. It's a different dynamic. And we're seeing it level off and coming right back into line with historical delinquency. So the fear and the kind of the fear mongering, and, there's a lot of media sensation around that. I think it's way overblown.
Yeah. I mean, if you think back to that 2008, 9, and 10 time period, right? To your point, your only option was you were either walking if you're trying to sell, or you were doing a short sale at some point, right? And you were not getting out of the loan, in full based off of the sales price. Here's a totally different environment, right? Even if, because you're right, a big percentage of our book took the option but continued to pay on time on a monthly basis. But as a trend for the entire country, as you come out of forbearance, God forbid if you're still impacted, I don't think the first reaction is going to be just let's walk from the house that has this much equity built in it. The first thing I'm going to do is try to list it and sell it, right? Like at the end of the day, and at the end of the day, you're doing it with a 15, 16, whatever it is, year over year increase that you've seen over the last 2 years from a home price appreciation perspective. It's a much different dynamic than it was back then when we went through this and kind of the forbearance, short sales, foreclosures, that type of thing.
Yeah, no, you're exactly right. And, there's this, going back to like the new entrants, kind of new variables in the market. You've got Zillow buying houses now, Open Door. I think Redfin maybe is getting into it, or if they're not, they are. So, that's 3 to 4% of the market now is these sources buying these homes and flipping them. And so that's another source of liquidity. If folks are in a jam, they've got the equity, they're willing to sell at a slight discount to get the cash tomorrow. These guys are stepping in and buying them. And it's starting to catch on in a fairly big way. And, is it timing? Is it a one-time thing? Is it going to be a year and a half that trade's going to be around? I don't know. I'm trying to wrap my head around that. But I think there'll always be people that'll want to sell at a discount for whatever reason. But right now, if you had to do something, immediately, there's a lot of liquidity out there that would buy your house. Not to mention just folks that want a house, they're trying to find one.
That's right. Just because of the lack of inventory, right?
Yeah. We never recovered. I mean, you could make the argument we really never recovered from 2008. I mean,
That's right.
From a home builder standpoint and housing inventory, and the growth of population, we were just getting into recovering when this whole thing hit in March of 2020.
That's right. Okay, real quick, I know we want to talk about on the next slide. I think it's one of the things a strategy that we've kind of implemented here from our RMBS program that we had stood up and we've kind of executed on. So, thoughts around that?
Yeah, so this is the fun stuff to talk about, right?
That's right.
It's being in the business for 25 years and dealing with Fannie, Freddie, and Ginnie and all the vanilla stuff, and it's all well and good, but it's been fun to be able to build a vehicle outside of the norm of everything that we've been doing for the last 25 or 30 years. So Flagstar in 2017 started a RMBS or a private label securitization desk here, and started issuing securities off our own shelf versus selling loans to Fannie, Freddie, or Ginnie, or private investor. So it really took off last year, but we've issued over almost 11 billion since the team was set up, and it doubled this year. Really, this year is really the kind of the breakout year, and we can thank the FHFA on that one probably a little bit with them pulling back on the dictating Fannie and Freddie at the 7% cap for investment properties and second homes. A lot of lenders and a lot of partners didn't have anywhere to go with that, so we were able to backfill that and securitize that in the private market, and lots of great liquidity there. We built a really efficient private market away from the government, which personally, when they backtracked and said, okay, now you can deliver back to Fannie and Freddie again, as a taxpayer, I was a little upset because the spirit is home ownership, right? It's not investment properties. It's not second homes for Fannie and Freddie. And also, we built a very, very good, deep, liquid market in the private sector to have these loans be off the back of the taxpayer if everything were to happen. So, I was a little bummed out to see that happen and backtrack, but I think it could happen again. The new leadership at FHFA, who knows where she's going to go with this. They suspended it for a year, but it could come back, but may not. I don't know. We still think the trade's there. There's still lots of interest in just conforming paper as well. So we did. We'll probably end the year this year with 12 or 13 deals. This is slightly dated because we just came out with Q3. Q3 numbers came out last week, and we were number 2. So it's JP Morgan, Flagstar, and Goldman Sachs as the top 3 issuers in the country for mortgage, residential mortgage debt. And I think that's, personally super proud of that. We're like the little bank out of Detroit that could, competing with these big giant Wall Street guys and money centers. So to be in that, mentioned in the same articles in the same breath as those two, it's quite an honor. But and then I think we've got a unique model. It's from the originator partners. We're an issuer. We service the bonds. So it's just a full service, fully integrated kind of a system that we've built that just, we can pull a lever and sell a loan to Fannie Mae. We can pull a lever, sell it privately. We could keep it in our portfolio, right? So
that's right.
Lots of options, lots of optionality.
Yeah, and I think it's your last slide, right? Which is if you're an owner of a company or a lender, what's the benefit of our program to them, right? And I think you touch on a couple good points here.
Yeah. So I kind of it looks like I kind of front ran this slide a little bit myself. Yeah. So I think we've been around for 30 plus years. We're not going anywhere, and I think it's fun to work here, especially my career has mostly been at non-banks. So to try to get out of my non-bank independent mortgage banker brain sometimes because we have so much more availability of tools and levers to pull here, and especially in the third party space for John and the team to help our partners. So, we're focused on execution for you guys, but also definitely want to keep focusing on alternatives, right? So Fannie and Freddie will continue to do whatever they're going to do, but I want to build and keep building alternatives to that. So we'll be there for you with, as the market moves in and out, we'll be there. We'll have options. I think from our standpoint, my team, capital markets, we're kind of the bookends of the process, right? We create the rate sheets, the products, and then we get them out the back end. And in between, we hedge them and price them and everything else. So we're here to help you guys be successful and do everything we can to give you every arrow in the quiver that we possibly could. So, other than that, I think most of this is kind of repetitive here. Customer retention, we retain it. I think the big thing for us is there's no middleman. If you deal with Flagstar, we go directly to the market. You sell, JP Morgan or Goldman Sachs, they're buying from 38 different lenders. Their bonds are a hodgepodge of guidelines. We're homogenous in our deals. Our deals are our guidelines, and it's backed by soon to be a $90 billion bank, right? So very, very powerful and a great liquidity partner from that side, that angle. So
yeah. So hey, couple questions, rapid fire, real quick, because we're running up against kind of wrapping this up.
Yeah.
First thing was somebody texted me and said, get his thoughts on the new leadership at FHFA and more specifically around what do you think, if any, changes to the additional changes going forward to the PSPA you would see, right? Because that's kind of what she suspended on a couple of these things with the percentages of non-owner or second homes that you could sell and a couple other things. So that was the first question. What do you think as far as the PSPA and any other changes in the future?
I can tell you, we spend a lot of time with the folks in DC on the phone, at least anyways. This push for low to moderate income housing is a big deal. It's a really big deal. It has been, but now it's really in the forefront in the spotlight, and she is the biggest proponent of that. What does that mean going forward? I'm not sure, but I think that we could see for the first time in a long time, some changes to the LLPA grids. So, I've thought about this too. What if the grids actually flip upside down, right? Like, what if your lower FICOs, higher LTVs have better rates than your higher credit, lower LTV borrower does? Because they've got to find a way to subsidize this and figure out how to get these folks in homes and make it cost effective, right? So a lot of thoughts around this. I think she's great for the program. I think she's been around for a long time. She can get things done. I think she already has. So I think the momentum's there. I think you're going to see more and more work things coming out around this on the low to moderate income. As far as the PSPA, I think that's out the window. The whole cash window thing, I think that's not going to. I just don't see that coming back. The $1.5 billion cap or whatever they had,
right?
The cap on the multiple risk layers, it was really weird. It was like no more than 3% deliveries based off of FICO, DTI, and something else, and that one actually made no sense at all, because that's going to be your low to moderate income. That's right. So I don't think that one's coming back. The only thing I just question on is the investment properties and the second homes. Because if your charter is to promote home ownership, it's not to give people an option to finance a second home or 10 investment properties, right? So they use that as basically a cash register to fund some other things that they do, right? So do they keep it around and charge the 300 or 400 basis points LLPAs, or do they do it to owner occupied borrowers that are higher quality and then subsidize the lower end? I don't know. I think they're going through the motions of trying to figure that out, and that's why they gave themselves a year to do it, because they're going to ask us as lenders, what's your input? How should we do this? But yeah, they're still in conservatorship. Who knows if they'll ever get out? Who knows what the structure is going to be going forward?
Right. I'll paraphrase this one into a simple question. the Ginnie Mae liquidity requirements that have been kicked out there and thrown around. Any insight or thoughts on that?
It's it's still in the discussion or comment period.
Right.
I just don't think it's going to happen. I mean, Fannie Freddie and Ginnie were both told to do this years ago, 2-3 years ago, and then Fannie Freddie just didn't really do it, and I don't think they told anybody at Ginnie to stop. Ginnie Mae is a very small operation. They don't have a lot of people, and it's just kind of it's a shell really to issue securities through. But I mean, maybe something will come out of it, but I just don't see it going all the way through.
Yeah. And then, hey, I thought this was a good one. The last one that came through to me is, if you were the owner of, let's say you were at, whatever, you owned your mortgage broker shop, or just as so you were a lender, right? You were a correspondent, you had your own capital markets group. If you were that owner, knowing what you know and all of your experience from running capital markets, like, as you go into 2022, what would keep you up at night? Like, what should you be thinking about that you're not thinking about today or be concerned about?
Oof, everything keeps me up at night. Yeah. I mean, I think it's what worries me, I think, is just some of the bigger players, just the race to the bottom for profitability. I mean, I think, holding your guns to, this is where I kind of want to be in the market, and I'm not going to chase all the way down to nothing. That's what I worry about. I have some other friends that have mortgage companies, and they try to run with the big boys a little bit. And it just, there's going to be a little turmoil here. These guys are going to put pressure on margins, and I think that worries me a little bit.
Yeah. Well, I think that's fair assessment, right? As you, as the owner of a company, if you're on here, or originator, again, self-employed, running your own book of business, I think those are all the economics that you have to look into, right? As far as where your book of business is being generated from, and the revenue that you're generating, where that profit sits today, and what does that look like going forward. I think those are all things that you need to be looking at as you kind of move into Q4, as you strategize for 2022 and beyond.
Yeah, no, I totally agree.
Well, cool, man. Hey, a couple more questions. Somebody asked a couple things about some of these slides. If we're going to get them out, as always, our originators will be able to get the deck out to you so you can see some of the slides and use them for your own purposes. Jason, hey, obviously you run capital markets over here. I've worked with you for a while. I certainly appreciate you jumping on the call today for our series and kind of sharing some insights and thoughts, because I think it was really valuable for the group to hear. So I appreciate you doing that.
Yeah, thanks. No, I appreciate it. Always fun to talk about what we do, and it's hopefully I didn't ramble too much, but been doing this for a long time, so it's kind of hard to take a step back sometimes and tell the story, right? You get caught up in kind of myopic vision sometimes. But
that's right.
Thanks for the invite.
That's right, man. I appreciate it. All right, cool. All right, gang. Well, hey, obviously, hopefully you got some value there. I think Jason brings a wealth of knowledge from a capital markets and secondary perspective. I argue he's one of the best in the business from what he does on a day in and day out basis. So to get him for a little while, hopefully brought some value and got you thinking about some things. Good news is we have our next one locked down in November. It won't be the second Thursday of the month. It's going to be the third Thursday of the month on the 18th. The 11th is Veterans Day, so we will not be doing it on Veterans Day. And we have Rick Sharga he's the executive vice president from Realty Track. He's going to join us and really dive into some statistics and stats and analytics on the housing market. If you haven't seen Rick before, I've seen him on a couple things, like with Josh Pish on Shreds and a couple other segments and venues that he's been on. He'll bring a wealth of knowledge and share some really good information with you. So look forward to that. And again, as always, stay safe, stay healthy. Thanks for doing business with Flagstar. We appreciate it very much, and have a great day.